the question for me is not how deep a recession. The question for me is like, where is it affecting me in my business? Welcome back to another episode of the Collecting Keys Real Estate Investing Podcast, the podcast by operators for operators. And today we have the operator, Dylan Cook. Mike is out at an Alex Hormozi event. But today I think we have a pretty full plate of good discussions. Dylan and I were pre-showing all the data, all the economic data, and I'll let you kind of run through it, Dylan, since you're the data guy for the show. And maybe we'll just have some super good conversation about what we both think is happening in the economy, and then dovetail that into how that relates to some of the stuff that you're dealing with in your business and what I'm dealing with mine, and maybe some opinions around how to operate your business in these uncertain times.
Yeah. I mean, I think the biggest, most important number that just came out from like an economic perspective is probably that the GDP release for quarter one of 2025 was negative 0.3%. And depending on, the definition of recession for most people is 2 consecutive quarters of negative GDP growth.
So everybody calls this now they're using the term technical recession, all the pundits, right? And I guess it depends on what side of the aisle you are from the pundit standpoint, but I feel like everybody wants to get away from that because they're like, well, a technical recession is 2, quarters of negative GDP, but really, that's not that bad.
Yeah, right. I mean, I don't know why. I hate that they always change the goalposts anyway.
Right.
So I'm just going to keep it at the 2 consecutive ones because that's what it's been forever. Even though that happened in like 2022, I think, and they never counted it.
Really? Oh,
yeah.
Did they? Oh, yeah. Makes sense.
So, but with this, I mean, if this is all lagging information, so you got to kind of think what is going to be ahead of this, right?
Mm-hmm.
And I think, this is just me thinking out loud. Trump the other day said, this is Biden's economy, not his. So and they also, if they're going to have all these tariffs in place, that should create probably even less GDP growth or maybe GDP decline. But I almost kind of think that they want a recession, and they kind of want a recession early for 2 reasons. One being a recession will get that 10-year yield down that we've talked about before. So people can refinance their houses, can refinance their car loans, get cheaper debt for basically everything. And then 2, they want this to happen early in the presidency because the primary is, still a year and a half to almost 2 years away. Yep. So if you knock this out early and you're on the uptrend, by the primaries come around, then you look a lot better at that point in time.
Totally. I like that theory. That's actually not a bad theory. The thing that I don't understand when it comes to like what's happening economically is the job market, and people still have jobs.
Yeah. I mean, you're right. You think most recessions would indicate a higher unemployment rate, which the May number was the April number that was released just the other day was added 177,000 jobs, but on a relative basis, the unemployment rate stayed at 4.2%. So it didn't change.
It didn't really move. It shifted around a little bit, and it's actually beat expectations. And so I'm like, totally, you could be in a recession and not really feel it. It depends on where you're at. A lot of times when we see recession, it feels like, and I think a lot of it is like the construction, because that's a big slowdown during like an economic slowdown. So the construction sectors, you tend to like slough off a lot of jobs. And in construction, in our industry, within real estate, is the most speculative area. If people are building and doing new construction and flipping and all that stuff, you're speculating the economy is going to do fine and it's going to sell at a certain price. And so you kind of see maybe the bloodbath more there. But if you work for the government, I mean, except for right now, I don't know what Doge is doing, but in the past, like when in 2008, for example, I was in the Army. I didn't know, my pay didn't change one bit, right? So if you work for the government or some of these really stable companies, that you don't notice it as much financially. And so it's like, what is going on? And then the market affects, you see your portfolio, your stock portfolio goes down during a recession.
Right.
But even right now, it's like, could we technically be in what is going to be defined as a recession? Like you said, it's a look back. So they usually, I heard this recently, was that when you're doing the recession, although a technical recession is 2 quarters of negative GDP growth, the economists come together afterwards and basically say, yeah, that was a recession.
Right.
With no true definition, right? They pick if it was that a recession? Yep. So right now, technically, we could be in a recession. And so I guess just my thought is like, do you feel any recessionary pressure?
Me, no, but I guess as you're saying that, I'm thinking not every recession is also created equal. The most
Mhm.
recent one that we have as that we lived through would have been like 2008, 10,
Yep.
barring the one in 2022 that they didn't count from
Right.
COVID. But so that was real estate heavy, but before that was 2000s, the dot-com bubble. So like
Hmm.
those set of employers would be different than what was 2008. Then before
Right.
that, I think it was like the 87 was around there. So, but my point is the sectors that lose their jobs are
Hmm.
different each time.
You're right.
And I think what's a little bit different now is because there's so much more wealth out there, that wealth effect that we keep talking about.
Yep.
If there is actually a recession now and people see their net worth goes down a lot, that's when they bring in the reins, right? They're a little bit more conservative on not only
Hmm.
their discretionary income, but on their investments, really everything, just the everyday life.
Absolutely. Yeah. And that I think is where now you see the pullback, or you will see the pullback. And that's why then you see companies' earnings go down because people aren't spending as much. I think in this one, we're throwing a little more of a unique wrench in it that I'm not in my lifetime have ever seen is the tariffs, which can like kind of screw up the imports, screw up the costs, and reduce demand. It's like a third party factor that nobody can account for. It's almost like a black swan, like which is I think why we're seeing so much uncertainty in the market recently, going up and down. Because really, I don't know what the market's doing today. I think it was like down 1%, so it's kind of a decent amount. But like up until this week, we were seeing quite a bit of volatility, and then it was kind of like back to scratch, right? Like back to what it was 12 months prior. So, which isn't a terrible thing for people who are investing. It's better than being down 6 or 7%.
Right. And I think the biggest thing is like markets don't like uncertainty. And even though Trump said, I'm going to do tariffs, no one expected how he was going to implement those tariffs. And
Yeah,
the
dude.
fact that
Yeah,
he's been they're on China. Now they're 185%.
yeah,
Now we're going to
yeah.
exclude all of this. I just think the constant changing
Hmm.
is what's really throwing a wrench into everything right
Absolutely.
now.
Yeah. Yeah, I would say a lack of communication, what seemingly is a lack of a plan. And there's I heard a good argument like that Trump believes like chaos elevates issues and elevates the conversation. And to a certain extent, I agree with that. I don't like the way he goes about things, but then all of a sudden you have now he's got the liberal Democrats talking about how important the stock market is, right? And like all these other things that before they weren't talking about. So he elevates an issue and then is going extreme one direction, and then now it's kind of back to like people are like maybe a little bit more in the middle on certain issues where he still seems extreme, right? But as the population, more people are towards the middle. But going about it with the uncertainties, especially when you're messing around with the world's biggest economy, it's like a cruise ship. You don't just like turn it on a dime, and you can't just
Yep.
like throw shit around because it does really affect people.
Yeah, which is why you saw some of the data that came out recently, like um, a lot of employers that source internationally, especially like medical devices was a big one I saw.
Oh,
They're all like front loading, like buying
mm,
tons of inventory now in
right,
anticipation of all that. So that's going to throw off some of these numbers anyway, because yeah, they look
right,
great right now because they bought so much stuff, but in a couple quarters or months from now, they'll be like, no one bought anything and not
right.
remembering what just happened.
Yeah, absolutely. Everybody's got a short. We all got a short term memory, dude. It's like we go based on quarters, and apparently that's how you operate a company too.
Yeah. Yeah. Well,
Yeah,
I mean, in the wholesaling business, some people are quarter by quarter. If you're in
this
here
is
for
true.
3+ years, you're kind of an anomaly.
This is true. We've seen that even in just the scale group and the mastermind and the different people we talk to as they look at different groups that they want to join, or just seeing people come and go from the groups. And like I would say, I don't know, like 50% of the people have left the industry, like trying to grow, not like left the industry, but have changed their course. I would say they're not necessarily not wholesaling. They're just not trying to wholesale a bunch, or they're like really focused on their portfolio right now.
Yeah. I mean, I see some of the same players in my own market, but I definitely seen a lot of people leave and then, not come back, especially when it was the heyday where you could throw something up on the MLS and it'd sell in a
Right.
day.
Totally.
But like right now, I mean, in my own business, we have, hold on, I just wrote this down, 9 in escrow and I'm flipping 2. And
That's pretty good, dude.
yeah, I know. But my point in bringing that up is, I feel like all of them are only one of them or two of them are currently assigned. And the sellers are either like, we have it at a decent price, and then there's ends up being like title issues, liens that ruin the deal. Like, or sellers remorse that they no longer want to sell, uncooperative tenants, something that just comes up. Or B, we have a lot of these leads that come in. They're like, let's say it's worth 225. I'm like, I'll take 200.
Right.
And like and I know that happens all the time. It just feels like there's more of that now than there has been in the past.
Yeah. I think too, I don't know. I don't know if it's because like, because I mean, 9 deals in escrow is a lot. Like that's a good amount. And so I was gonna what I was gonna say is like sometimes when there isn't like a ton going on, like you just kind of uncover all of the problems, and then you just start working those ones with problems, and where before you might just overlook them. I don't think that's the case because we have quite a bit of abundance right now, and we're dealing with a lot of that stuff. And we have been. Mike and I swear to God, we always have the worst luck with some of that stuff. One of the things that we're dealing with right now are we've got 3 sub 2 deals, and I don't like sub 2 deals. Like that's like the last resort for me. But we've got 3 of them that are like okay deals, but not really good enough to do much with, right? Unless you're acquiring. And I'm personally not trying to actively acquire sub 2 deals right now. But I know other people are. So we'll probably, out of those 3, we'll probably wholesale 2 of them and find a buyer for them. But it's like just the weirdest seller situations. We have one right now that I'm trying to figure out where she has 200-ish thousand in equity, we haven't walked the house, and it's a newer build, like built in like 2005, 3-bed, 2-bath, an old lady she's dying of cancer. And she's like, I absolutely don't want to move, but I lose $300 a month living here that I put on a credit card. Like her total living expenses, she loses $300 a month, but she's like, I'm dying and I don't want to move. She called to get a reverse mortgage, which seems like it would fit her situation perfectly, but they denied her. I don't know why. I don't know the whole reverse mortgage industry because she has a lot of equity in it. But like, I'm just looking at it and she's like, I just want to be able to stay here. How can you allow me to stay here? I need to pay off $15,000 in credit card bills. And then she had like another 10,000 something she needs paid off. And then she's like, and I just want to live here for cheap because like her income's say like, I don't know, like $2,100 a month. And she wants to live there for like 900. So she has the rest to spend. Like that's a great deal, honestly, for us. And we haven't negotiated like what she wants to do with her equity and all that sort of stuff. But to me, it sounds like right now she just doesn't care. She's like, I just want to die here. And she's probably got 3 to 5 years left. No, I don't know what it is. Like it's not dire like the next 6 months. But if she wants $100,000 in her pocket to go have fun with, like that's not a deal. Like
right.
she has like a weird situation that she doesn't want to move. She's like, I just want to die here. And it's like financially that might not be the best choice for you, but she doesn't care because she's dying.
Yeah, she's dying. And it might, the whole family dynamics also come into play with that.
Oh yeah.
We have a sub 2 on that, or it's not really sub 2, it's a seller finance one where it's like a rent by the room, but we're getting it at 5% interest on a 30-year AM with a 5-year blend. And these are the ones like, so I might even take it down and then just manage it for a year and then sell it, because some of these ones, and I'll get your opinion on this, is like, okay, I can make 10 to 15K on like a wholesale fee maybe, or like you flip it and you can make 25 to 30, but those are kind of thin margins when you're flipping.
Yeah.
So, and these fit where I could take it down, fix it up a little bit, probably burn it out and like maybe have 10 to 20 left in the deal, but then sell it a year later. And then now I have probably close to $75,000 to $100,000 in equity.
Yeah.
And the place is nicer. And I only pay, I guess, long-term capital gains, 15-ish% instead of ordinary income tax.
Yeah.
So I don't know. This is like the exit strategies I'm changing because I don't need the immediate liquidity.
Right.
And just holding on to it for a year.
It's not bad. We have a very similar one, sub 2 deal, where it's like we would basically break even with it. You just the cash flow on it would basically pay for the maintenance that you're never going to have and turnovers, right? It's a unique property. It's got like a shop. So we want to see if we can get a little extra cash flow out of it for like a contractor that wants to like rent a house plus have like his shop to like store all of his materials and equipment in. So could be a potentially awesome deal. We'll break even on it. Do we hold it for a few years and then just sell it? Because we're going to be basically zero out of pocket. We've got to pay excise tax and some closing costs. And then we have to pay the realtor that brought it to us a fee. So say we're out like $15,000 total, and we're going to have 0% return for a few years. But then you're buying it with some equity in it now, kind of like you're talking like 30,000, 40,000 maybe. But then you have selling costs right now. So you're like, it's just kind of tight to do anything with. So do we hold it for a few years? Just put it with property manager, pre-fund an account so that it's just, if there's maintenance, we don't think about it. It just takes care of itself. And then in 5 years, we get a 80, 70, 80, $90,000 payday. Like, it's like a piggy bank, right? There's risk though, in that you have some of these major items break and now you got to fork over cash. But if it's not a bad property, then it might make sense if you don't need the cash right now.
We sold, the last partnership I had, we sold seller finance on a year term that'll come up in November, and it's almost like I forgot about it. We collect like $900 a month.
Oh, nice!
But like come November, I get a check for $80,000.
That's badass.
Yeah, and so like then I'm like thinking, do I count this as my marketing spend? Like that now my KPIs are all changed because I got $80,000 coming in. Like,
yeah, dude.
But it's gonna be like a nice little like I don't know,
little bump, dude. It's like finding $20 in your ski coat the next year. It's the best kind of money.
It's a lot more than that, but yes.
Yeah. Well, I think that I kind of think of it as like land banking, but you're kind of house banking instead. Like there's a lot of guys out there that they have cash and they just park it in a vacant piece of land because there's really no downside risks to the land other than values. But if the land is in a really good area and it's going to go up in value over 5 to 10 years and you just needed to put cash somewhere, it's the same thing. It's better than the savings account.
Yeah. You don't get the, you can't really depreciate a whole lot.
No,
property
you can't
taxes
depreciate anything, but you can park your money there and bank it. And if it goes up 3, 4, 5, 6% a year, you're making money, and it's a good place to put it. And
some of that, I brought that up too because, as the audience probably knows, like my AM is, I don't know, we're probably 3 months in now, close to that, and my days used to be spent basically sourcing revenue most of the time, marketing and sourcing revenue. Mm-hmm. And now that I'm still taking care of the marketing, he's doing a lot of the calling and the task follow-up and appointments and all this kind of stuff. My job is turned into keep feeding the machine, but then dispoing some of these. And so there has been a little bit of disconnect, even though I'm the one making the final offers. I haven't necessarily seen these places in person.
Mm-hmm.
And so the dispo side has been a little bit more challenging than I thought. And, hopefully we close on all these. I have I can, if I need to, I don't want to. Yeah.
So do you find that he walks and takes photos, you do your underwriting, and then maybe you're doing a walkthrough of the dispo and you're like, oh, this place is a little grosser than it looked like in the pictures, or what do you see?
Yeah, honestly, that like the most recent one we had was, I was like, my MAO man is 90,000, and even below that, like I would want to be a little bit below that. And we've had 3 offers so far, and all of them are basically between 85 and 90 grand.
Yeah, that sucks. That sucks.
So like, we might go back and retrade and, and try to do that. I don't want to, but I'm still trying to dispo it. So like, it's just stuff like that. And so it's my fault. I got to get it at a steeper of a discount, but
totally. I mean, it's growing pains too with having an AM, and then they learn when they have to go make that phone call.
Yeah.
You know what I mean?
Dude, I wish I could play this for the audience, because it was basically like, hey man, MAO is 90. And I was like, but start out at like 81,750, because he told us he wanted like 100 to 110. So I was like, I don't want to start too low because he just shut us out.
Yeah.
And then so, my AB gets on the phone and he's like, hey man, so with everything, all cash, no closing costs, we'll close on your timeline. I'll be like 81,750. And the seller's on the other line. He goes, well, think you can come up to 90? And immediately I was like, yep, we can do 90. Yes, bro, you could have got it for probably 85.
Oh my God, dude.
But he knew what he knew what that. So that was a coaching opportunity.
Oh my God, here. Damn AMs. Yeah. But it's an MO for a reason.
Yeah, I know. But that's just an example of the growing pains that you go through that you don't kind of anticipate when you hire somebody on.
Absolutely. Yes. And the cool thing is, though, is as long as you're able to feed the machine and you're able to give him learning opportunities, because it sucks when you're so thirsty that you're really mad and now you create like a wedge between you and your AM, and then you just end up firing because you can't work with him because like in the back of your head, you're like, I hate doing this because it's bullshit.
Well, if every deal he gets under contract we don't close on, like that's not going to be he's going to hate that.
Yeah, he's going to hate that too. Yeah. And then you both are just like, okay, this is bullshit. So whatever.
Oh, man. The other thing, like, what's going on with me personally is like, the rental side of things. As we talk about adding more, I've had to put 2 new roofs on, an AC condenser, and I forget something else on a new so I've had close to 30 grand just in like expenses, CapEx stuff that doesn't increase the property value, doesn't increase NOI. It's just some costs in owning these places.
When you underwrite properties, like you're going to bring a new property online that you're buying, what is your monthly CapEx, OpEx, for just set asides total for those? What do you factor in?
Yeah, so it's something that I'm not going to put a whole lot of like actually burr it, where we're not going to do like the put new mechanicals in it on the front end.
Yeah.
Then I'll do anything from 15 to 20% of the top line in total.
Really?
And then,
Okay.
So like, but that's vacancy, maintenance, CapEx, property management. That's everything.
Oh, okay. That's everything. Okay.
But if it's something that we're taking it down, we're replacing everything, I'm good. I'll do 5 to 10% off the top lines, because all the stuff is new. It should last me 10 to 15 years.
And do you try to do that when you, if you're going to burr a property and you like it, you're like, I want to keep this thing, even if the furnace is working, but it's old, like an old oil furnace or something? Are you trying to just upgrade that shit then?
Ideally you do it on the front end, and then like you can kind of wrap it into your financing costs a little bit. Yeah. But I haven't lately, and then I haven't bought anything to keep in 2025 so far. And I need to change that. There's one under contract right now that I think I'm going to keep. But
yeah, I asked because the way I got into real estate, a good friend of mine, he's like, man, I don't know. I buy these houses and I just make them bulletproof when I buy them, and I only have to do it once. And I started out, that's kind of how I did it. Mike came, when him and I partnered, came from a little bit different point of view, which is like, how do we maximize the ROI? But what I have found, and him and I have found, is like in some of these situations, it freaking screws you over, because year 4 after burring it, you've got a roof, a furnace, and some other hot water tank or something like that. And you can't really get that money out of it, especially right now with where your rates are. And so you're like, well, I guess I'm just stuck putting $15K, and you don't have the cash flow, like the reserves built up by then. So now it's like an owner contribution to your to your property to do it. And so it's like, there's like this fine balance. You really got to check that stuff, because, you could probably get away with having a little bit more dings on the wall, or like a little bit rougher carpet, and stretch your carpet out a year. You can't get away with not having a furnace. So the furnace fails, you have to replace it, right? The carpet, you're like, I'll stretch it out. You know what I mean?
Roof. And I'll even throw like gutters in there, because water is like the bane of existence for all properties, right? Like that, or the grading around like the side of your house. Don't let it just constantly flow into your foundation.
Totally. I agree. Water is the worst thing ever. And that's gutters, I found early on, were like the cheapest way to make sure your properties don't suck. And before that, I would have never even known houses had gutters on them. Like I knew they existed, but I never was like, dude, those are nice gutters. Like, you know what I mean? You look at like, right? Dude, solid gutters. They're seamless.
This is where like what we're talking about though is like the onesie twosies landlords. Like this is kind of where some of them get in trouble, is that they don't have the money for the unit turn, so now they're renting out at below market value, but you get the tenants that aren't going to take care of it. It's just a cycle until eventually the property's almost
totally
destroyed.
Totally. Absolutely. We have one right now that we're selling. This is actually a funny story. I should tell this since we're talking about portfolios. So Mike and I actually have right now, we have 1, 2, 3 of our portfolio properties that we're actively selling right now. We're not selling any of them. But one of them was that exact situation. He was like, he bought the property. We bought 2 houses from him. He's like in his 80s. Principal only financing. Good deal. There are 2 little houses, 2-1, and one is a 1-1 right next door to each other. And the one we ended up selling, and turns out it wasn't that nice. Like, I mean, the whole freaking subfloor was just rotted out. Like, we got into renovating it. We're like, let's just sell this for a profit. We made a little bit of money. And so now we have this house next door, and the seller financing note on it's like $82,000 left. And every month we write them a check for $600. We were renting it for like $900, but we weren't really doing any maintenance on this thing. It was just kind of running along, because we had, the full disclosure, we had 2 like developmentally disabled adults in it, and like their siblings were the ones that were like their I don't know what you call them, like their guardians. And so they would just pay us each like $450 a month. And these disabled adults lived there. They had jobs and stuff, but they were, they weren't capable of really truly living on their own. And so because of that, they never said anything. So they move out, and not only did they move out, they're just like, by the way, we're not paying you rent. We're just moving. We're just leaving. And I was like, I don't know about that. And then they just sent me a bunch of pictures of the house. And I'm like, well, like we told the previous owner of all these issues. And we bought this house like 2 or 3 years ago. So they just been renting from us, whatever. We told them about all these like electrical issues and this, that. And I was like, first of all, I'm not the previous owner, but also I can't really do anything. Like, what am I going to do? Like go like enforce the lease and be like, you owe me 1 more month's rent, because they're on month to month. We had leased them originally for like 12 months and then put them on month to month. And anyways, they just freaking moved out. And so now we got this house. To get market value out of it, we probably need to put like 25 grand into it, right? Maybe more. And that would say get us to 200,000 with the notes at 80. So do we really put 25 grand into it to get 200, or do we try to just sell it as is for like 120? That's kind of where we're at. Cause it's like, it's worth the risk to put the money into it? Probably not. Let's just try to sell it as is to another investor. So we called the neighbors next door who bought the first house from us to see if they want to buy this little house from us to see if we can sell. Cause it's a 400 square foot house. Like there's almost no comps for something that small, right? It's just kind of tough. And so like, how do we salvage this and make a little bit of money on it? Because it's a great seller financing note, but it's just kind of a funny situation and something you deal with when you buy shitty properties. This is also the thing I contend with on seller financing is like, if your property is a shit ton of CapEx, like the seller financing might not be as lucrative because how are you going to get that out? And this guy he wanted no prepayment. Like he did not want his money. He's in his 80s. He's like, I just need cash and I don't want it all at once. He just like, I want it monthly for whatever reason, taxes and all that stuff. And so you have to be kind of careful. We're paying the price on this one. And we knew that getting into it, but we're definitely paying the price on that.
Well, and I love your point about like the creative finance ones. One, if they want equity, it's tough. But two, if there's $50K of work, then you're still coming out of pocket that $50K no matter what.
No shit.
Unless you're like agreeing them to do a second position and taking a first for the you can try to get finance with it, but the probability of those going through is slim to none.
Absolutely. And,
okay. So now you do your CapEx, like your money in, your cash on that. And I'm assuming it's not worth the 5% rate or whatever it is that you're getting.
0% rate on this one.
Whatever. Take your cash flow over, that CapEx budget.
Totally. You're absolutely right. You're absolutely right. No, point made. Well, outside of that, as we kind of wind down and wrap up, talked about the economic news. How is that going to affect all of your operations here based on like, what are you doing differently, if anything, as an operator, given the Q1 data, given the fact that you just spent $30,000 on your rentals?
Yeah. So one of the things is I try to be data driven in most of the stuff that we do. So I'll go back and look at what marketing has worked, what hasn't worked. And historically, it's the same list. High equity absentee is still like almost 50% of our deal flow. Direct mail is still most of the deal sourcing. So I'll continue to do more of the same. My biggest like hesitation, I guess, is it comes from some of my go-to buyers being less aggressive. So am I willing to take the properties down or at least source new buyers to take on some of these deals? And I'm looking at the stuff that I have like under escrow right now. And this is pretty true for most of the stuff I market to, is if I need to, I can turn them into rentals and at least break even or lose a couple $100 a month almost every month. Right. And I'm okay with that. So to answer your question, I'll keep doing more of the same on the marketing and lead gen side, but I might be more taking some of these down, either wholesaling or flipping versus assigning.
Do you see there being any option for you at, because I like what you're saying and I definitely understand why you're saying it. Is there any reason why maybe you would bring on some investor cash to help facilitate that like acquisition of a bunch of great properties at a great time in the market?
Do you mean like a private lender?
But for long-term financing, like, hey, I can buy 10 properties this year. I'm going to go raise $1 million for that. And then I'm going to own, half of them, 50% ownership, but you're bringing no money. You're just bringing the deal.
Oh, I see what you're saying.
Yeah.
I hadn't thought about that, but that's an option. Yeah.
Yeah. It's just
especially
kind
if
of
liquidity was low or something. Like I would see that as a creative solution.
Right. Yeah. And I bring that up because it's like if you're a deal sourcer, you're almost in a conundrum if you have a hard time with the exit. We're going through our own Dispo, like growing pains and like different things where you're like, why aren't they buying this deal? And then, so you're dropping some and you're renegotiating some. And for the most part, we're still moving things pretty well. But come a time where it's a good deal, but you eventually run out of cash, or you want to keep your cash reserves for operating your deal gen. But you don't want to give all these deals. Like Mike and I, we've had a handful of guys over the years that, like pretty, I would say wealthy people with deeper pockets to be like, why are you even passing on a single deal? Why do you even sell any of them? Just buy them all. And it's like, well, yeah, obviously I would love to buy them all. But the cash it takes to buy them all and keep them and the cash reserves it takes to mitigate any risk of $30,000 bills is larger than most of us can handle as we're growing a portfolio, as we're scaling up our wholesaling and flipping operation. There's just only so much money.
Yeah, so much money and so much time. I mean, holding stuff is a different business. And yes, you can have a property manager, but you still have to like know what their job is so that you can do it. And if you're just starting, I would recommend you manage your own, at least for a couple, year or two, just so you know the ropes.
It helps a ton for sure.
So that's an idea. I'm assuming with some of the connections that we could do out of pocket, $0 on 50%. And then you structure those as JVs or separate LLCs. I guess that's the other question for another day. But heads turning now, I guess. Brains turning.
Yeah, right. Yeah, if you're out there and you're thinking like, hey, I can source deals. I know I'm going to run out of cash.
Isn't that what like Cam Cathcart doesn't he do something similar to that?
He raised a fund from Mike and I were talking to him, I don't know when this was, but he had kind of talked about having a handful of people in a fund that he was able to raise. And I can't remember how much. It was multiple seven figures. And that was kind of the idea for him, because he's not really big into wholesaling. He's just kind of flips or keeps everything. He does wholesale though, but that's not his go-to strategy. And so he just saw an opportunity in the market of like, I've got all these guys that really need to place money but don't want to do it on the single family residential like deal sourcing side. He's like, but I'm good at that. So he sourced a bunch of properties, and then basically the fund bought them, and then he also has a property management company, so like just threw him under that. If you have the systems in place and you know how to find deals, you could do a lot here. You could buy a lot of properties, even ones like, think about this, like you're at that 80% of value, right? You're like, God, but if I have to get hard money and then I have to burn this, and then I'm not getting my money out. Well, when that factor is gone and you can go and buy Apple stock for a 20% discount, why wouldn't you go and get every loan you can that anybody will ever give you? You know what I mean? Like, absolutely.
Yeah. I mean, a $250,000, let's say, rehab project, acquisition and rehab at 12 at standard hard money rates for 6 months, that's 20 grand. Like,
exactly.
So no, that's a good point. And then you buy a $250,000 house for 200,000, you're 50,000 in equity with no money out. You just keep adding those.
Yeah. Well, and here's also why it's kind of top of mind for me. I was just on a call. I was meeting with a GoBundance guy today. He runs a private money business, which Mike and I have been scaling our private money business, and he has quite a bit more experience. And he was just talking about, and this is something that I guess we've been seeing, at least Mike and I have observed anyways from our purview, is there's a lot of money going into the buy and hold side right now. When I say money, I mean institutional dollars coming there to support that industry. And so the flipping, the residential fix and flip, they'll love to loan on it because that's great margins, but there's just not as many people right now buying deals from guys like Dylan and I, right? And so they're not able to do as many loans there. But on the DSCR side of things, the rates, as more and more money come in, the rates are getting more and more competitive. And so you're seeing lower and lower rates on the DSCR side, even with like shorter prepayment penalties, like 2 years and stuff like that. You're starting to see, compared to, I feel like when Mike and I were first doing this, like we'd go and get commercial loans from our bank all the time, but they're like 5-7 year ARMs, all that stuff. And so it's like, they're great rates, they're local, they're easy to get. But then as we got into the DSCR side, it was just like, God damn, they rake you over the coals on all your fees, on all the prepayment penalties, all that stuff. Where now, you're not seeing hardly any of that. The fees are not that, they're nowhere near what they used to be. And it's because it's getting more and more competitive with the institutional dollars who are competing for those of you listening to this podcast that have a portfolio, because they not only see you as like a person with experience, they see you as a person with assets usually. They're like, Dylan has this many properties versus FHA buyer who has one property. Do I want to buy a mortgage-backed security off of an FHA bundle, or do I want to buy these? And these are becoming so much more
50% equity position, stuff like that. Exactly. I actually just sent Mike a guy today that is in GoBundance that is considering, like, he owns, I bet it's about $5 million worth of real estate that's paid off. And he wants to maybe take out like a 50% LTV so he can redeploy that money because his cash on cash and his return on equity is shit. It's nothing. Right. So he's exactly pull out enough to break even, right? So he's not losing any money every month, but then he's going to redeploy $250K and whatever, or $2.5 million and whatever he wants.
Absolutely. Yeah, that's That's a smart idea. And when you have that's just for the audience, just for knowledge too. When you have that great of an LTV, you get really good rates. They really, really favor experience, and they really, really favor LTV. Like by experience, I'll also kind of throw in credit score in there. Like if you have a higher credit score, like above 680 or 700, that helps along with your experience. But the LTV is what's going to swing your rates. You'll get rates in the sixes right now with like a 50% LTV. It's pretty awesome, which is unheard of.
Here's on that experience. This experience statement made me think of this, and this is just a tidbit for the audience. My insurance broker told me that if your property is professionally managed, you get a slightly better rate on your premiums, on your insurance premiums.
No shit.
So even though I self-manage, I should create a property management LLC. That way I can say it is professionally managed and then get better insurance rates.
Absolutely.
Just something that's I never had thought about until about a week ago.
I didn't even know that was, I didn't know that was a thing. That's good to know. Because especially if you have a large enough amount of properties, I mean, if that comes into like a 5% reduction in your premium every single month across all your property, that's huge cash flow. That's real money. That's real money. That's cash money gold, dude. I wish I had a
do you have
sound
anything
effect
else,
for that.
Dan? I didn't have much else to report on today.
No, I think I really just wanted to talk about all like the GDP, the jobs, and kind of like, I don't think it's as bad as it looks. You know what I mean? It's kind of interesting. It's like a slower landing. And I think you and I probably would agree on this. I think that we're probably heading into a recession. The question is like, the question for me is not how deep a recession. The question for me is like, where is it affecting me in my business? And I'm wondering if it's going to not affect me as much. The only place that's probably affecting me right now personally is my new construction project that I've delayed, not because I didn't want to start this spring, because I'm in a permitting delay, and I'm in like the goddamn matrix right now with it. So I'm pushing it to the fall to start that. But I'm hearing, okay, the builder sentiment's going down because of the worries about tariffs and imports and all that sort of stuff.
Yeah, and that just is probably a material thing, right? Like
I think so. And I think people get uncomfortable because they perceive that if the market goes down, that people will less likely go buy new construction. But at the same time, on that side of things, like if you're going in a new construction, right, you're competing against existing product. The new construction will always trade at a higher cost, but if anything, it'll trade at the same cost as the other stuff. And so, as long as you have profits built in, they're just not as big. And
if you're a one-off builder like what you're doing, Dan, that's not nearly going to affect you as someone who's a national home builder.
Right. And the thing that the national home builders have now that they've freaking figured out is they'll just restrict it. They'll just stop building and then sell off what they have at the current prices. And they have all the hedge fund money backing them to say, we're going to offer everybody a $30,000 incentive to buy this house so they can clear their inventory. They'll clear it at break even, or maybe they'll clear it at a 3 or 4% loss but they know they can now reset and then build the next 50 to 100 homes in that project at a different pricing structure. And so I really strongly believe they figured out. I don't think that we're going to see anytime soon these national home builders go belly up. I think they truly have enough money behind them now. And I feel like they figure that out to where they can just restrict supply. They can do whatever the hell they want.
Yep, makes sense. And it is crazy how much like pull they get with like local jurisdictions. Like we want to, like if you went to somewhere like you're in this permitting hell, I feel like if one of their reps went in, be like, we want to build a subdivision over here. They'd be like, we'll have you ready by next week.
Exactly, dude. Well, they'll come. DR Horton will come in. They'll have a big giant office with all their people. And they have one person that just works permits. And the interesting thing is the reason why it's tricky in Washington. And this audience, you're probably bored at this point, and you're going to sign out. But in Washington, we have a bunch of energy codes that have recently changed and continue to change, and it's really boggling the designers here in Spokane, like where I'm at. They don't really know how to handle it yet because it's all fresh. And then the city itself is changing their minds on things. And so like we have to build these houses super highly energy efficient. Sometimes that means you have to put solar panels on them just to meet code. Wow. And the problem is you have these national home builders here will go literally put up a cardboard box, but somehow pass all their inspections. And that's the highest energy efficiency thing. And I'm just trying to build a house that passes freaking inspection. So anyhow.
Tale as old as time.
Tale as old as time. All right. That's all I got, Dylan. Anything else for the audience?
No, I'm good.
All right, everybody. Have a great rest of your week. See ya.